a panel of some of the brightest stars in the studio firmament. And you know, I let them. I don't think I can do justice introducing them. So why don't I let them introduce themselves to you, and then we can learn from them. Jack, you wanna?
Perfect.
Take it?
Great to meet everyone. My name's Jack Abraham. I'm a serial entrepreneur. I was fortunate to grow up in an entrepreneurial family. I joined my dad's company when I was 12 or 13 as a software engineer. Saw it go public for billions of dollars and starting companies at age 15. I started my first company right out of Wharton undergrad, which is where I went for business school, and kind of built it through the Great Recession. Coming out the backside of that, we had the opportunity to raise a big Series B or be acquired by eBay. I was 24 years old at the time and decided to proceed with the acquisition. Got to run the local division of eBay, worked very closely with John Donahoe, the CEO, who since has gone on to run ServiceNow and Nike in the near future. And I used that time, I did actually a lot of work inside of a company doing almost a mini studio model, creating a lot of teams to build products that really helped eBay succeed, including some products that drove the stock price pretty meaningfully while I was there. I got into angel investing and was an angel in Pinterest and got involved with Uber later on, Flatiron Health, Doctor on Demand, gave the founders of Postmates the idea for the company, and got involved with several other companies. And then I had by the time I was ready to leave eBay, I had 250 ideas for my next company written down in a list in an Evernote file. And I thought, rather than pick one of these and sort of devote the next decade of my life to doing that, I should probably go through a process to figure out which of these 250 could be the top 10 and turn them into companies. And we actually started Atomic in 2012. It was the first studio of its kind, which was the first fund model ever invented in 2012. We've been doing it since then. Raised our first fund in 2013 with Peter Thiel being our largest backer and Mark Andreessen, a lot of luminaries from Silicon Valley. Raised our second fund in 2017, which has been doing well, and happy to share more. We've founded about 20 companies out of Atomic at this point.
Okay, then one point I just want to make it. A lot of times I have institutional investors ask me, they're like, Alex, so how do the founders apply to a studio? And I was like, no, the founders, the actual founders are the ones sitting in front of you. So they found the companies, and then due to the strength of their networks and the strength of their credibility, they attract the co-founders.
Yeah, that's a very important point. Okay, I'm Michael Fertik, Heroic Ventures. I live in Palo Alto. We are a studio, a formation venture company firm. We focus only on Silicon Valley and Israel. Jack is an old friend, Khaled is an old friend. By the way, we are not competitive with each other because we start our own companies. So a different dynamic in ventures, we don't compete because we're starting our own companies. We are rooting for each other and also for the great growth in India and so forth, and amazing successes here. The other thing is that we start with the entire company. We own the whole company. The economics are very unusual, therefore. I started my first company when I was 19, similar story to Jack. I did not grow up in an entrepreneurial household. I grew up in a household of artists. I started my first company in 19 when I was in college. I sold that. Have had a bunch of companies in sales and exits since then. Heroic Ventures, I started with my own money. And then we got institutional capital about a year ago, which has been great. We've sold companies to some of the megacorp companies, and we've got some companies that are coming along that I hope we will not sell. I hope we will IPO them. I think recruiting is a very, very important part of this DNA, right? So we are recruiting talent, we're getting talent in the door, and then we're also selling our companies to the bigger VCs, who can then help grow the companies. This is a very different business. I think the lady who asked the question in the last session asked a very important question, especially for a crowd like this. Is this a different way of doing venture? Yes and no. Can corporations do it? No and no. And we can tell you more about that in a second.
Definitely. Hi everybody, my name is Khaled from Stipple Capital. It's really great to be here. My background is kind of a mix of both of those. I grew up in Egypt, entrepreneurial family, third generation entrepreneur, and I moved to the US. I went to school there. I joined the startup. 6 months later, the startup got acquired by Rackspace when they were 200 people. 4 years later, $35 billion public company, 4,000 people. I was running the strategy team there. I left, I started a smaller startup called Tilt. It was a YC company, Y Combinator, raised a lot of money from Andreessen, and we sold to Airbnb. And after that, I started a company in the mortgage space, so my focus is mainly on fintech and kind of its intersection with other sectors like prop tech and insurance. And I was messing around with a few different ideas, and I remember a day where Alex reached out to me and he said, hey, I really like what you're doing with Red Door, we should talk. And I told him I'm not really raising for Red Door. He said, no, it's okay, we don't invest in the company directly anyways. I said, what do you mean? And he was kind of introducing me to the studio model, and it turns out that I was building a studio without actually knowing that it was a studio. So it's a really exciting time to be doing that, and we're raising our first fund and getting the ground running.
Great, thank you. So I think we've shared a little bit about the kind of disruption in venture. What we haven't talked about is how valuations are incredibly high. Seed funds now have a really hard time getting the ownership that they got a few years ago. And also there are so many of these seed funds, right? So many companies. So why did you start the studio model today? I mean, clearly you could have just think, and why do you think it's different right now?
So first of all, I think it's important to differentiate what is an accelerator and what is a formation studio. So an accelerator and a studio are two good ideas, but they're very different. An accelerator receives business plans, has a 5-minute pitch, gives $50,000, gets a small percentage of the company, and then helps the company get ready for later funding. That's kind of what works, and sometimes it's a very, very successful model. Formation is we start the company, we do a lot of the hard work, and we start with 100% of the company. So when you start with 100% of the company for $500,000, $1 million, $2 million, the opportunity for upside of the investment is very significant, right? This is kind of like venture capital in 1995, or maybe I could say 1985, right? The golden days in some way of venture capital. I started a studio by accident. Like Jack and like Khaled, I wanted to start more than one company, and in Silicon Valley, the talent pool is very diverse. There are AI people, there are data science people, there are machine learning people, there are health people, there are life sciences people, and I was able to attract talent. And so I said, okay, let's start a couple of these companies. And then we had a lot of success very early. And then Alex and Trang found me. And they said, do you want to start a studio? I said, what's that? They said, it's what you've been doing. I said, yes, I want to keep doing that. And that's how we got into that business.
Yeah, I remember, so Mark Andreessen, he was an investor at one of my companies. And I remember almost 7 years ago now, he was saying, we're entering a time where starting a company never been easier and building a business never been harder. And if you look at this, you kind of realize entrepreneurs that just know the timing, know the industries, are experts at what they do and how to build a company and grow it into a successful business. You end up with the best economics when you actually build this yourself. And any entrepreneur that kind of built 1 or 2 companies before, they just can't help it that they always have kind of an intuition towards ideas and timing and towards figuring out the right deal flow. And because they are the founder of the companies, they end up with kind of the best economics before it even gets to an accelerator or a seed stage. That's why I built the studio.
For me, I think there are a couple of things, and we started earlier. We started in 2012 than my colleagues up here. But what Alex showed earlier of the cost of starting a company coming down is a trend that's going to continue to play out over the next decade, several decades. When I was starting, it started to be possible to build an initial product for around $500,000. A decade before 2012, it might have cost $5 or $10 million to build a product. So that was one trend that was occurring. I'd say now it's gotten down to the point where you can actually build a product for $25,000 or $50,000 in some cases, which enables a lot of rapid iteration, a lot of testing, a lot of scaling, a lot of putting products in market, understanding how customers really engage with them and like them. So I think that's the first thing. The second thing is something I actually thought about ever since I was a kid, when I was thinking about a studio model, which is that one of the problems in society is there's so much that's broken in society, there's so many problems, there's so much opportunity for innovation and new approaches. But one of the issues is the people in industries where there are opportunities for disruption don't necessarily collide with engineers or technologists or software people. And I thought, man, you know, every now and then that happens and you get really great innovation that can occur. But if there could just be an entity that could organize that better and build super teams of, you know, people who understand the challenges facing an industry or a problem set and who can execute on the technology, that would be a really, really optimal setup. And I think that we're starting to transition into an age where, as you know, startups are getting cheaper to build, technology is becoming free. The vast majority of technology can be downloaded for free from the internet on GitHub. A lot can be accessed for free from APIs on AWS. We're really transitioning into this technology deployment age of how can technology transform industries, other facets of life. You know, it used to be that we would just play in the software industry, which in the United States is a $180 billion industry. Some of the singular companies we've started, Atomic, I can think of two off the top of my head, are disrupting trillion-dollar industries each. So the TAMs are a lot bigger, and in this sort of age, it's really about not just identifying opportunities, but how do you assemble the optimal team, and you know, maybe the great technologists that could build the AI to disrupt a system in a particular industry. The people would never meet, the company would never be formed, and I think that's a distinct advantage that we're seeing kind of play out right now as well.
Another thought on this, just coming back to the capital class or the investable class, the asset class question, right? So not just the operational questions, but the asset class question. Venture capital is broken, we know that, right? And there's very little information as to why it's broken or how it's broken. But one thing that has changed is the venture funds have largely gotten much bigger. And they've gotten bigger because of Digital Sky or because of SoftBank or for whatever reason, they got a lot bigger. And all of a sudden, when you're collecting a 2% management fee on $2 or $3 billion, all of a sudden that's real money every year. So the incentives of the managers have changed a lot. And even the best people will behave differently in that scenario. So when I started the studio, I said, I'm not going to collect any management fees, zero. I do not collect any fee to manage money. So we are perfectly aligned. If we succeed, then we make a lot of money, and we should make a lot of money, and I should make a lot of money. But we see that something is rotten now in venture capital. Many people will succeed anyway, but something is very rotten. And that also goes to pricing. The average seed money price in Silicon Valley, plus or minus, 12 years ago, was $2.5 or $3 million pre-money. Now the average seed money price in Silicon Valley is about $9 million pre-money. The exits in that time, the exits have roughly doubled in value, but the pre-money has roughly tripled or more in value. That is physics. That's physics. That's a law. You cannot escape that. And you can't point to Uber, you can't point to the other one, you cannot point to any exceptions because it's the mean, it's the average that makes the investable asset class. So I think our approach is a different approach to correct for that set of unfavorable trends that have changed venture capital.
So it seems like the studio model provides great advantages to the LPs. Not the least that the institutional investors now get to work with amazing entrepreneurs like yourself instead of giving money to all the great VCs who invest in your companies, which is also good. But they get things. So yeah, it's a great. What are some of the other advantages you think? I mean, you've mentioned some great ones, and we've seen a diversity of studio models, and they continue to evolve. All of them good. At the end of the day, it's what people make it work. So
I think one of the biggest advantages of the studio model is proprietary deal flow. One of the things that's happening right now in the venture capital industry is there's so many dollars out there, so many funds, there's new funds starting all the time. Anything that's good becomes known, becomes very competitive, and the price shoots up. And as a result, it's really difficult to kind of get material ownership. A lot of times those rounds get split, so you can't get enough ownership, and the price is very high. If we think back to what always drives really, really high fund multiples in venture capital, it's really three things. One, it's high ownership percentage. Because we're forming the companies, the ownership percentage that our funds are able to get relative to virtually any VC in Silicon Valley, and especially any seed VC in Silicon Valley, is substantially higher. In many cases, it could be 2, 3, 4 times higher.
10 times higher.
Two,
yeah.
sometimes it could be 10 times
Yeah.
higher. Two, the pricing. I don't know how all of our models stack up, but our model at Atomic is actually designed so that there's tranched investing where for about a $2 million check size, our fund ends up owning around 25% of the company. Could range between 20 and 30% of the company. So low cost basis, high ownership percentage. The third thing is of winners, companies that could become very large and ultimately return the fund in and of themselves. And we've developed processes around validating ideas that are kind of unfair advantages that no one really does in the venture capital industry. By the time we're starting a company, the amount of tests we're doing, the interviews we've done, the focus groups, we'll do marketing tests, go-to-market tests, we'll build the products, we'll really even understand truly what this business is going to look like at scale and the unit economics that are going to drive that before even starting the company. We've developed a lot of methodologies around that, which gives us a lot of confidence that not only this is a great idea, but this is going to be a great business, and we're going to understand how to scale this, and we're going to be able to do it quickly. At Atomic, for our most recent 4 companies we've started, we've gotten them to the first $1 million of revenue in between 1 to 4 months of launching them. There's one we just launched that got to $1 million in revenue in 5 days. So when you really do this process well, you understand what you're building, you understand what the customer wants, you understand the path to scale, you can scale these businesses faster. And so again, high ownership percentage, low cost basis of winners is really, I think that's at least how I think about how we've designed our model.
There's another advantage that is, that's a great list. When you do it a lot, and you know how to validate a business idea. By the way, no validation process is perfect, right? But when you know how to validate a business idea, it becomes a muscle that you exercise a lot. You can learn how to do it. That's true. There's probably another set of truths that's specific to Silicon Valley, maybe also to Israel where I work. In Silicon Valley, the talent is very expensive. It's extremely expensive. And housing is very expensive. Housing is a huge problem in Silicon Valley. So when you have a very talented co-founder personality, he or she is probably making $700,000 or $800,000 at Facebook or at Google or at Apple. And maybe she has 3 kids, and she can't leave a job and make $0 for 6 months or 2 years. And the classic venture capitalist, who is now making 2% management fees on $3 billion per year, says, oh yeah, you should leave your job and make $0 for 2 years while you work on your startup. And if you don't, you're not an entrepreneur, which is kind of insulting and also false. Now, if you have a studio model and you don't have to pay yourself, I don't have to pay myself, I can use that cash to recruit a better co-founder who is perhaps the world's greatest machine learning person for AI in conversation out of a public company. And she is making, or he is making, $1 million a year, and we can pay that person $250,000 or $300,000 a year immediately. So that person is taking a pay cut, but that person understands that they can still make their bills, and actually they don't have to leave their house. So you have an advantage in the studio model of an instant company with instant funding that can recruit some of that best talent, and all of a sudden now you have a real company with one of the world's best people. The traditional attitude in Silicon Valley, by the way, there are a lot of traditional attitudes in Silicon Valley, even though Silicon Valley is so new. One of the traditional attitudes in Silicon Valley is that the founder should be willing to work for $0. I worked for $0 for many years, but I was 19, I was 20, I was 22. And if you're 32 or you're 40 years old and you have a family and you're the best person in the world in your field, Facebook and Google and Microsoft and Amazon are doing a good job by keeping you there for $1 million a year. That is what they should do. So we have to fight and compete well with them. So we can give you a lot of stock and a lesser salary, but at least you can you can keep your house. That's another tactic that is very different for recruiting some very top talent. That might not exist in India or in China as a problem, but in Silicon Valley it's a huge problem, and in Israel it's also a problem.
Yeah, I mean, for Stipple Capital, we kind of have a very similar model where significant kind of ownership, no management fee. I think that is kind of, it is the existing model for studios, and I believe it's the right model for studios, especially the kind of that generation that's truly innovating on what that model actually looks like. But another advantage for LPs, the way I think of it, is actually just deal flow, the type of companies that the studio is able to build. The question earlier about kind of corporations building their own labs and studios, and the problem with that is attracting the kind of the right entrepreneurs and growing it to the level that a third-party entrepreneur outside kind of growing this model. This really only works with studios. Top talent, top entrepreneurs would just join the studio for the diversity that they can get from the studio, that the ability that they can kind of shop that company around. And so it ends up with better economics for them. So for LPs, and depending on the different types of LPs, there's a lot of LPs that come to us, I'm sure all of us as well, with their own problem space and their own domain and their own type of ideas that they want to experiment with and get somebody to kind of look at it at a deeper level. And I think that's another huge value for LPs, to get direct access to entrepreneurs that are building those studios to build those ideas.
The one final thing I'll do super quick, just because I think it's actually an important point.
Yeah.
So with studios relative to venture capital, the other really, really important element is studios tend to have control of the companies. And control is very, very valuable and very, very important for a few reasons. One is companies are risky, and sometimes even with all the testing you do, even being really smart, picking the right people, things can go wrong. There are things out of your control. Competitive dynamics can change. You want to be able to react to them. You want to make sure the company can work. If you have control, kind of closer to almost private equity, which you have in a studio model, you can fix the company. You can change the management. You can pivot the business. You can institute any sort of changes that you need to make the company succeed. In our case, we've been fortunate that we've been more right than wrong, but every now and then, when we've had that situation come up, we've taken a company and we've actually turned it into a pretty great success, which has been great. The second thing that I think is really important with that is really LP alignment from the perspective of generating returns, continuing to be able to manage the investment. As companies raise more capital and later stage investors get more control, the terms tend to really dilute early stage investors and make it difficult for early stage investors to generate liquidity. Additionally, because founders have so much control typically, they're delaying going public, they're delaying M&A, they're delaying any liquidity events for LPs. Because we have control, we can actually control when liquidity occurs for companies and how it occurs, which we think can actually introduce better liquidity faster than the venture funds typically will be able to.
Oh, great point. And just on that, we heard one of the top VCs, multi-stage VCs, and they said, that in reaction to seed funds also trying to get more ownership, they said they were not going to let seed funds take their pro rata anymore because they weren't adding value. So yeah, it's a very thing. So all these things I think bode really, really well for the proprietary deal flow, the control, the talent. We've had a long run of great upmarket, and I think what do you see in 2020 and beyond? How are you positioning your portfolios now?
For the economy?
Yeah, for the economy as well as your portfolios. Like what is your kind of
Raise your hand if you know the name Elizabeth Warren. So watch that stock very carefully. We will know a lot more from Iowa. So look, 2020 is an election year. We are very exposed to the US stock market. We've had a terrific bull run. Nobody can predict the future. But the things that might matter are a lot of people who are expert on DC believe that Trump has built some tension with China so that he can release the tension with China in 2020 and keep the stock market up. Maybe that's true, maybe it's not. I am worried about, I am a Democrat, I am worried about some of the Democratic language, and some of the Democrats, if they are nominated, will punish wealth, and so we have to be careful. Now, it's very important. Let's go back to first principles. If you own the company, by the way, we're not a classic venture firm. A classic venture firm will tell you they help build the company. An accelerator will tell you they help teach you how to pitch. We actually build the company. So we own the company. And if you own the company for a $2.5 million post-money valuation, then you have a lot more room to maneuver if the stock market or if valuations come down by half or by 70% or by 30%. There will be pain in a situation like that. Everyone will take pain. But if your valuation is 2.5 post and the next round was 9 post or 12 post, the risk of the impact is lower. Now, on the other hand, we have to prepare because we need cash to survive a difficult time. Silicon Valley is a very fashionable place. And all of a sudden the sector is hot, and now it's not hot. All of a sudden everyone is investing, now no one is investing. I know all of you who are entrepreneurs have felt this. And I know all of you who are investors also know this. So we have to prepare. We have to be smart. I do think that sometime in Q3 of next year it will be uncomfortable. But I am watching Elizabeth Warren specifically. I think Sanders is finished. And I think Elizabeth Warren will create risk for the stock market, which then affects us in Silicon Valley a lot. If Buttigieg, the short soldier from Indiana, if Buttigieg wins the Iowa caucus, then maybe we're better off. I'm not telling you how we should vote. I'm just telling you a financial question. Does that answer your question?
It's your answer.
But it's not that. Am I answering the category question, or are you looking for a different kind of answer?
It's all good.
Okay.
Yeah, I'm going to talk maybe a little bit more on the kind of the portfolio composition and its relation to what may or may not happen. In Stipple, we focus on fintech and its cross-section and cross-pollination with other industries. So the cross-section between fintech and real estate, for example, and we do a lot of work in mortgages, cross-section between fintech and insurance, and we do a lot of work there as well. And so we tend to go into kind of unsexy industries, and we try to make them really cool. And we find kind of the loopholes there. On the plus side of those type of industries, they don't disappear. So no matter what happens kind of in the economy, there's always a cycle. But they tend to be pretty stable in that sense. And like Michael was saying, if you own that significant portion of the company at a very low kind of 2 million, 2.5 post, you can weather a lot of the different variation and kind of what the pricing looks like in Silicon Valley. So in that angle, I'm actually very optimistic in terms of the portfolio composition and what happened. I think if anything, it would actually make studios shine even more, and the value add for LPs would really show in times like that.
So I would say a couple of things. One thing is, it's really interesting, we've been fortunate to partner with a lot of great institutional investors, and I'm also an investor myself. I track the economy quite a bit, and the other asset classes in alternatives that investors tend to invest in are not doing as well as they historically would do. So private credit in the US, you look at the top funds, KKR, the Blackstone, the Carlyle groups of the world, they're at negative net IRRs. The hedge funds are, for the most part imploding. They're really not doing that well. in the United States. They've been underperforming the S&P 500 for a long period of time. Private equity, there's a lot of competition, particularly in the mid-market, that seems to be driving down returns. So venture has been the bright spot in anyone's portfolio that has a good kind of allocation to alternatives, and it's grown a lot. It's actually been the best performer of everyone's portfolios. And partially as a result of that, there's a lot more money that wants to go into venture. There's a lot more money that wants to go into the growth stage. If you can't put money into private equity as easily, if you can't put money into the public markets via hedge funds, you're probably going to want to put it into growth equity. You're probably going to want to put it into late stage venture, normal venture, and all the way down to seed. So what we're seeing is just, I think there's more interest than ever in putting capital into our ecosystem, because we generate the companies that all that capital goes into. Sort of, no matter what happens to the economy, we should be in good shape. What ends up happening is there's a flight to quality, essentially, when there are issues with the economy, where venture capitalists like to work with known quantities. They want to work with founders they know, that they've backed before, that they trust, that have reputations. They want to work on good businesses that are validated, that have strong unit economics with really strong teams, all of which we really focus on building and validating. So I actually think if there were to be a flight to quality, we would enormously benefit from it. But I would actually say I'm very bullish on the economy personally. People talk about uncertainty around China, uncertainty around the election. I'm a big believer in, things should be valued on a multiple of earnings, and the earnings keep being really great. Just watch the earnings reports of the companies. The companies are doing very, very well. Technology now represents about 25% of the S&P 500 by market cap. There's not much debt used to grow those companies. It's not very sensitive to interest rates. I think central banks have changed over time, where central banks are now more proactive rather than reactive, and they're lowering interest rates earlier than before. Many countries around the world have learned to use negative interest rates, like in Japan, that kind of have continued the debt cycle. So it really seems like, in my view anyway, I don't see many sort of clouds on the horizon from the economy's perspective. And if anything, what I see from the capital allocators going into alternatives, there's going to be more capital flowing into our ecosystem. And as long as you buy that there are going to be great companies created through a model like ours at the earliest phases, we're going to stand to benefit from that, probably more than anyone else in the ecosystem.
I'm rooting for that answer, but I don't agree with it. So I do think that this party will end, and I think the party will end in the next year or two or three, and I think the U.S. economy will be fine, but the stock market and the economy will become uncoupled again. And so we're in a sugar hive. Like, we keep stuffing the beehive with sugar, right? So something will happen, and by the way, I think it'll be healthy. I think it will be healthy. And I think if you own a lot for a very small amount of money, I think it'll be healthy. Now, I'm 41. I started my first company when I was 19 in college. I went to Harvard. I started in the dorm room. Half the people who work for me have never seen a recession. They've never seen a bad market. So one of the companies I started, called Reputation.com, you might have heard of it, we had a layoff of 50% of our people in 2008. Do you remember 2008? Some of you are not old enough to remember 2008. So 2008 was really bad. And we laid off half our people, and we still grew every quarter. We never had a down quarter. So if you have that experience and you can make the tough decisions, I think you have the ability to navigate that difficult time. All of you have navigated difficult times or have been part of teams that have done so. If you have never done that, then I think you're in a lot of trouble, and you're going to learn a lot of lessons. Now, by the way, I don't believe the downturn, when it comes, will be as bad as 2008. 2008 was really bad. And also, I don't think it will be as bad as 2001. Do you remember 2001? I remember 2001 and the internet. And this was when things lost 95% of their value in the internet. And I started my first company in 1999. And I built my company through that, and I sold my company in 2002. So I've now experienced two downturns, and many people have not, and that's fine. I think if you have that experience, you can be very aggressive about it. Now, by the way, I think venture if you've been paying an average of 100 pre or 200 pre, I think you're doomed. And I think the partners who made those decisions are doomed. And I think the associates who made those decisions are going to lose their minds because they don't know what a bad time looks like. So I think that this will come. I hope it does not come for a few reasons in my portfolio till approximately 2021. So you can go home tonight and you can pray for Michael Fertik and Heroic Ventures, 2021 at the earliest, okay? But I think it's coming, and by the way, I think it's healthy, and then I think we'll be very strong after that. Our muscles will be stronger, and we'll lose some fat, and we'll be leaner, and that'll be good.
Why don't I open it to the audience? We have give you a chance. By the way, we're going to have a big break after this also, so that gives you a chance to talk one-on-one as well. Please.
Okay, thank you very much for your talk. And I'm a venture capitalist in Japan, and we are also concerned that VC in Japan will be also disrupted because the money is commodity. So my question is that how do the CEOs from your startup studio keep the CEO role until the IPO or M&A? Or once you start your startups, then after 1 year or 2 years later, then you hire the new CEO or new co-founder from outside of your startup studio.
So when they start, they are the CEO. So you are looking at the CEOs. Then most of the time, maybe you can talk about it.
Yeah, there's two ways to do it, and on the economy, I just respectfully disagree.
Yeah.
I don't think valuation is but also, what can cause the economy to do really poorly is if there's bad debt that is like on the balance sheet of all the banks. I don't really see it, so I'm going to agree to disagree. But back to your question.
It's so good, because if he's right, I make more money, and if I'm right, I was smarter first.
So sorry, but so the two ways that we start companies, one is we'll start with the person or people, and we'll pick, we have 550 potential ideas for companies, we'll pick 15 together, and then we have a process for going through, finding the top 3, testing those, finding the top 1, and then building the company. That's about a 6 to 9 month process for us, where we learn a lot about the person or people, and we get to figure out, is this person going to be the CEO or not, for sure. Sometimes we know absolutely this person's going to be the CEO. Sometimes they're a GM, they could become the CEO, and we might give them the ability to graduate and then become the CEO over time. And then the other path is we start the companies. We're, at Atomic, there's 4 GPs. We've all started billion-dollar companies before. We have 30 people on staff. We have engineers and designers. So we can very easily start the companies, and we'll try to get them to between 5 and 20 million in revenue if we're going to start them, and then we'll try to bring in someone as a CEO. And not only will we make them CEO, we'll actually give them a co-founder title. We'll give them a co-founding stake at that point. We'll let them bring in their people to build out a team. We'll let them set the culture. So it's a very, very compelling value proposition that enables us to get some of the best people in Silicon Valley. We've gone head-to-head with the top partners at Sequoia Capital on some of the top talented people in Silicon Valley over the last 3 or 4 searches, and we've won on each of them, like 3 out of 3. So both of those models have ended up working well for us, and it's just situation dependent. So.
I have a question as well. So these potential CEOs, are they already a part of Atomic? Are they employed by Atomic, and then you sort of like pick and choose, kind of like consultancy?
So they're usually not at Atomic. Sometimes they could be. We like to think of Atomic as a family that's ever growing. We have like 700 people across our portfolio now. And sometimes there are superstars that we like to, if they did really well in a company, instead of them leaving to do something else, we'll have them come in and maybe consider starting a company with us in the future. So that's one source. But more often than not, it's just our network. People are getting referred to us all the time that could be great for us to work with. And we have a big process for essentially interviewing them for this founder in residence program, where we go through this process of evaluating them and the ideas. And it's almost entirely network driven for us. I don't think we've ever used a recruiter for that.
Are there any issues with adverse selection, in the sense that if they're really good, maybe they just do it themselves?
Yes.
No. I guess we disagree a lot.
Yeah, I don't think any really awesome entrepreneur who's been working at Stanford for 2 years with a roommate on an idea for 2 years and has early revenue should join a studio. I invest in those companies too, and I don't invest from the same pool, and I discourage them from joining a studio. I also think the professional CEOs who take a company from $5 to $10 million and grow it are a different class of person. But let me attack the question slightly differently, which is this. So Silicon Valley is a very religious place. It does not believe in God, but it believes in a lot of other things. It's a very religious place, and one of its religions is that the CEO is sort of, the special human being. And by the way, if you've been a CEO in Silicon Valley, that's very valuable for you. There's a fetish, if you know the word. There's a religion around, different word from fetish, around being a CEO. So that's been very good for us as CEOs in Silicon Valley. But if you roll back, if you just look under the covers, for the first 6 months or 12 months or 18 months of many companies, not all companies, but many companies, often the CEO is expensive overhead. So unless the CEO is checking in code or running the product himself or herself. So often the best person to lead the group is a well-paid product person or engineer, and then you might have a different role of what being a CEO means. I think there are different ideas about this, probably even on this panel, but if you just look at the facts and you take away the religion about Silicon Valley, and there's a lot of religion about Silicon Valley, and religion is very powerful, right? Religion is something that can make something false into something that is true, right? That's one way of looking at religion. You can take something false and make it something true, because if everyone believes the same religion, then if you do the religious thing, then people reward you for that. But if you look at the facts, sometimes you can start to develop a new religion or a different idea. So, look, I have had a disagreement with some other people about this before. I do not think great, usually very young, founder types, 22, 24 out of college, should go to a studio and become those founders there, CEOs there. I do think that people who already have a mortgage, who are already experts in a field in their 30s or 40s could be a much better fit for that. One thing that we do is we hire no children. And there are adult children and there are young children. We have no children at Heroic. That's a religion for us. It's one of our religions. So yes, I do think there's some adverse selection, but I don't think that's the main problem. I think that the main problem is we are too religious about these things in Silicon Valley.
Yeah, no question.
As for the entrepreneurs, so I think in Japan there hasn't not so many entrepreneurs as compared to the Silicon Valley.
Correct.
Or India or China. So what do you think the major bottleneck is? And
in Japan?
The talent or the money or the
in Japan?
All of them. So
in Japan? I think the problem in Japan is you've criminalized failure. Right? If you fail, then you're a criminal, socially or actually. Also in Japan, you've criminalized success. Some of the great entrepreneurs and tech entrepreneurs in Japan have gone to jail. So I think the problem is cultural, and I think it's very deep. And I think every Japanese person I know agrees with this, and yet this will not change. And therefore, I think you should take your vast sums of money and you should put it outside of Japan. And therefore, you can pay for the pensions for the aging society in Japan, and we will do the work for you.
I was just also going to say, I actually disagree with the adverse selection point. I mean, we've had people who have come and sold companies for hundreds of millions of dollars join our FIR program. We've had someone who started a company that is doing well over 100 million ARR join our FIR program. There's a key assumption in your question, which is if you had a person with the same idea and a studio with the same idea, yes, they should not join the studio. I think one of the magical things, at least about us at Atomic, is we believe ideas are incredibly important. And of these 550 ideas, the opportunity to come, pick 15, and find what could be a power law outcome company, a truly exceptional idea to work on. I actually think the smarter that people are and like the more capable they are, the more they actually value working with great people, and the more that they value it on working on a great idea. And at least in our experience, that's led to us getting better people and not worse people. So, you know, there's an assumption in there around there being a singular idea, like, and many, many, many talented people who could be entrepreneurs at any given point in their life. The probability that they have a great idea, I think, is actually pretty low. If they do have a great idea at that point in their life, they should go into it.
Yeah, I take Jack's view on that. The thing, I'll tell you kind of a personal experience. A while ago, I was a YC founder, and I was building a company, and it was out of Texas. And after we launched, a month later, we were the #1 startup in Texas, and that felt good for like 10 seconds. And we realized at the time there was only 5 startups. And so we needed to go where the pros are, and we applied at YC. At the time, every company at YC was basically just an idea and a couple of people working together. And at the time, we were a product that's already launched. We had already raised, I think, $500,000 at the time. We were already making revenue. We had a team. The company was much more mature than pretty much any company in the batch at the time. And so people were telling us, why would you do that? The same kind of similar question they were asking. And for us, the reason we chose to do it is because we needed to tap into the network. There was other resources that a good entrepreneur knows that they need to be strong at what they do. And YC was kind of the gate for us to do something like that. Similarly, what you look at for studios today, for these entrepreneurs, some entrepreneurs are really good at specific skill set, but there's other things that they need to get, and studios offer that to them in a very powerful way. And so,
great. Well, I'll let you, we're going to take a break now. It's going to be ample time for networking. We reconvene at 3:35, so it's many of the speakers will be around.
Thank you,
So
Alex.
please,